Hey everyone, welcome back to Magic Market, where we break down the biggest stock market trends. Today we're talking about one of Disney's most valuable assets, its theme parks. You probably know Disney as the company behind blockbuster films, Disney Plus, and ESPN. But did you know that theme parks are one of the biggest drivers of Disney's stock price? How exactly do Disneyland, Disney World, and Disney's global resorts impact the company's financials? And what does that mean for investors? Let's dive in. Disney's theme parks are more than just vacation destinations. They're a massive revenue machine that helps fuel the company's overall success. In 2023, Disney's Parks, Experiences and Products division brought in over $32 billion in revenue, more than any other business segment. Even in challenging times, the parks provide consistent cash flow, making them a key factor in Disney's stock price movements. In this video, we'll break down how theme parks contribute to Disney's financials, their impact on Disney's stock performance over time, and the risks and opportunities for Disney's parks moving forward. Disney operates 6 major resort locations worldwide: Walt Disney World in Florida, Disneyland Resort in California, Disneyland Paris in France, Shanghai, Disney Resort in China, Hong Kong Disneyland also in China, and Tokyo Disney Resort in Japan, which is operated under a licensing agreement. Each park generates revenue through ticket sales, hotel stays, food and merchandise, and premium experiences. Ticket prices. Park admission fees continue to rise, increasing per-guest revenue. Hotels and resorts. Disney owns a large number of on-site hotels, which attract guests willing to spend more for convenience. Merchandising and food. From $15 Mickey ears to $200 lightsabers, in-park shopping is a huge revenue stream. Disney Genie Plus and Lightning Lane paid skip-the-line features have become a major source of profit. Every time Disney raises prices or adds premium offerings, it directly impacts profitability and, ultimately, the stock price. Historically, Disney's stock has moved in response to theme park performance. Here's how. 1. Parks revenue is a leading indicator. Disney's quarterly earnings reports often highlight theme park performance. When park revenues are strong, Disney stock tends to rise. For example, during the post-pandemic recovery from 2021 to 2022, when Disney parks reopened after COVID-19 closures, revenue surged, and Disney's stock price climbed nearly 40% in 2021. 2. Parks help offset weakness in other divisions. Disney's media and streaming businesses can be volatile, but theme parks provide steady cash flow that supports overall company profitability. For instance, in 2023, while Disney Plus was losing money, the parks generated enough revenue to keep the company's earnings stable. Investors see this as a safety net, reducing risk. 3. Attendance trends directly affect stock sentiment. If park attendance is strong, it signals consumer confidence and high demand. If attendance drops, investors worry about economic slowdowns. For example, during the 2008 recession, Disney's theme park revenue slowed and the stock declined. In 2023, when reports suggested lower Disney World attendance, the stock briefly dropped. This makes park trends a crucial factor for investors watching Disney stock. While Disney's theme parks are a major strength, they also come with risks that investors should watch. First, economic downturns can hurt attendance. Theme parks are a luxury expense. When the economy slows, people cut back on vacations. For example, during COVID-19, park closures caused Disney's revenue to plummet, leading to a sharp decline in stock price. Second, high operating costs. Running theme parks is expensive. Disney spends billions on maintenance, labor, and new attractions. For instance, the company is investing $60 billion into park expansions over the next decade, a huge bet that may not pay off immediately. Third, international risks. Disney relies on global tourism, which can be impacted by political and economic events. For example, in 2019, protests in Hong Kong led to lower attendance at Hong Kong Disneyland, hurting Disney's earnings. These challenges mean Disney must continuously innovate to keep park revenue growing. Despite the risks, Disney is doubling down on its theme park business as a long-term growth strategy. The biggest growth drivers include a $60 billion expansion plan, more rides, new lands, and cruise ship growth. There's also technology integration with virtual queue systems and AI-powered guest experiences. Additionally, international expansion with potential new parks in emerging markets. If these initiatives succeed, Disney's theme parks could become an even stronger driver of stock performance. So, how do Disney's theme parks influence the stock? They provide a reliable revenue stream that supports Disney's overall financial health. Strong theme park earnings help boost investor confidence and stabilize stock performance. However, economic downturns and high costs can create challenges that investors should monitor. Bottom line, if you believe in the long-term strength of Disney's parks, they could be a reason to consider Disney stock as a long-term investment. That's it for today's deep dive. Do you think Disney's parks will continue to be a strong growth driver, or are the risks too high? Let us know in the comments. And don't forget to like, subscribe, and turn on notifications for more stock market insights. Thanks for watching the Magic Market.